Have you ever stopped to think about what actually happens to the money millions of people deposit into their accounts every single day? It's a pretty fascinating question, especially when you realize that trillions of dollars are moving through these global systems every 24 hours. I think a lot of us still hold on to this mental image of a bank as this giant, impenetrable vault where our cash just sits quietly in the dark, waiting for us to come back and withdraw it. But the reality? It's completely different. Banks are definitely not passive storage units. They are highly optimized, extremely active profit engines. So in this explainer, we're going to break down exactly how banks take everyday deposits and transform them into literal billions of dollars in revenue. So, do they simply keep your money? Well, let's just shatter that myth right out of the gate. If a bank just locked your cash away and waited around, there's no way they'd be among the wealthiest institutions in the world. There is a deeply embedded, high-velocity business model running constantly behind the scenes, one that most of us never even notice when we're just swiping a debit card or depositing a paycheck. Here's our roadmap for today. We're going to start by looking at the financial middleman. Then we'll explore their biggest profit engine, dive into credit cards and fees, scale all the way up to investments and financial services, and finally, we'll look at why banks are powerful. This whole structure is going to take us from the journey of a single everyday deposit all the way up to macro-level global finance. All right, let's jump right into part one, the financial middleman. Picture this. On one side, we have savers. This is everyday people or businesses who just have some excess capital and want a safe, secure place to park it. Then, on the flip side, we've got borrowers. These are individuals and entrepreneurs who need immediate capital, maybe to buy a house, start a new business, or finance their operations. The bank basically acts as the ultimate financial middleman connecting these two. And the absolute genius of this model is risk absorption. Think about it. As an individual saver, you probably wouldn't want to take on the massive risk of lending your life savings directly to a total stranger who's starting a new company. But the bank steps in. They aggregate the funds of thousands of savers, and they deploy that capital to the borrowers. They take on the risk of default, and in exchange, they get the power to control the flow of capital. This dynamic is the very foundation of global banking. Moving right along to part two, the biggest profit engine. Let's say you walk in and drop $1,000 into your savings account. That money, it doesn't sit idle for even a single day. The velocity of modern banking demands immediate deployment. So almost instantly, the bank takes a huge chunk of your deposited money and lends it right back out to another customer. It could be someone getting a mortgage or a business taking out a line of credit. The bank then charges that borrower interest on the loan. It is a continuous, rapid-fire cycle. The exact moment liquidity enters the system, it's repackaged and sent back out to generate yield. The money is literally always moving, constantly working. Now let's look at the actual math making this possible. As a saver, the bank might reward you with, say, a 2% interest rate for providing them with that liquidity. But simultaneously, they're turning around and charging a borrower a 7% interest rate for access to those exact same funds. So the bank pays out 2% to keep you happy, but they're collecting 7% from the borrower. It is just a perfectly calibrated arbitrage system. Which brings us to a massively important concept in finance, the interest spread. It's exactly what it sounds like. The difference between the interest rate a bank pays out to savers and the rate it charges to borrowers. In our example just now, the spread is that 5% sitting right there in the middle. But look, this isn't just static math. Banks actually have entire departments dedicated to optimizing this spread. They carefully adjust their rates based on central bank policies and broader economic conditions. Because even a fraction of a percent change in the spread can dictate millions in quarterly earnings. It is absolutely the core engine of bank profitability. It's the silent machinery churning away in the background of every single mortgage, auto loan, and corporate credit line they issue. And what happens when you scale that up? You get billions of dollars. Sure, a 5% spread on a single $1,000 deposit is pretty small potatoes. But banks are playing a massive volume game here. They are essentially stacking pennies millions of times an hour. By multiplying this relatively small interest spread across millions of active loans all over the globe, they transform those razor-thin margins into billions in annual profit. It's an incredibly resilient, highly scaled system. All right, let's pivot a bit. Part three, credit cards and fees. There's this old saying in the banking world, responsible users enjoy convenience, but irresponsible spending creates profits. Credit cards are an immensely powerful money machine for banks. Every single time a balance isn't paid in full and on time, interest starts compounding rapidly. And as we all know, credit card interest rates are notoriously high, often hovering well over 20%. The banks heavily incentivize you to use their cards, right? They throw points and cash back at you. And if you pay it off perfectly every month, hey, you get a convenient tool.
But the absolute second you carry a balance, you transition from being a simple user into a direct, highly profitable revenue stream. But even if you diligently avoid loans and credit card debt entirely, banks have engineered plenty of ways to monetize your daily financial existence. Just think about all those little charges: monthly account maintenance fees, ATM fees, international transfer costs, overdraft penalties, check processing fees, currency exchange markups. A $3 ATM fee or a $15 wire charge probably feels pretty insignificant to you in the moment, but when you apply that at scale, with tens of millions of customers triggering these tiny individual fees globally every single month, it stacks up into a multi-billion-dollar safety net of nearly risk-free revenue.
Okay, let's step it up to the macro level. Part 4, investments and financial services. Large institutional banks go way, way beyond what you or I experience at our local branch. They're operating on a massive corporate level. We're talking underwriting government bonds, managing massive corporate mergers, and providing extremely lucrative wealth management services for ultra-high net worth clients. When a massive corporation needs to raise $1 billion, they don't just walk in and take out a standard loan. They use an investment bank to issue bonds or shares to the public. The bank acts as the advisor and the underwriter, and they take a percentage fee for structuring the whole deal. These advisory fees and the commissions they make from sophisticated investment products, they completely dwarf the margins of everyday consumer lending, generating tens of billions in extra income for the banks every single year.
Which brings us to our final section, Part 5, Why Banks Are Powerful. Now, given these staggering profits and all those fees we just talked about, it is super easy to view this whole system cynically. But let's run a quick thought experiment. Imagine a world without this banking infrastructure. Without a mechanism to pool and deploy capital, businesses just couldn't expand. Families couldn't secure the leverage they need to buy homes, and students wouldn't have the opportunities to finance higher education. The velocity of money would completely grind to a halt. But with banks acting as the circulatory system of the economy, money actually flows safely. Governments can move massive funds efficiently, and capital gets deployed where it's most needed to spur innovation and growth. Despite the profit motives, it is an absolutely essential industry for modern society.
Ultimately, what you have to realize is that the banking business model isn't built on just one thing. It's not a one-trick pony. It is a highly optimized, multi-layered machine where traditional loans, high-yield credit cards, everyday transaction fees, and massive institutional business services all feed into the exact same ecosystem. Millions of financial transactions are taking place every single second across the globe, and each one is generating a fractional yield that compounds the bank's overall profitability. They have diversified their income streams so perfectly that they are insulated against almost any isolated economic shock.
So, as we wrap up this explainer, I want to leave you with this final thought. Banks aren't just protecting your money. They're actively using financial systems, lending, and advisory services to build the most profitable businesses on earth. They are the ultimate masters of leverage. So the next time you deposit your paycheck or swipe your debit card, you really have to ask yourself, is your money working for you or is it working for them?